So since that info slide was very long, and apologies to the younger members of the audience, we are debating whether we would permit mandatory arbitration clauses in disputes between investors and companies. I don't know why the info slide was phrased that way, but that's what we're talking about. What is our policy? To say that we will permit these clauses to be in contracts means that companies, at the point at which they do an IPO, an initial public offering, are allowed to have these in the contracts. It's not mandatory, as in all other free and fair market transactions, they make the choice. Two, we want to point out that the vast majority of arbitration usually results in some kind of satisfactory settlement for both sides. In fact, we know that in commercial arbitration, about 4/5 of all these cases never end up going to court and save both parties millions or even billions of dollars in litigation costs. And three, if the arbitration fails, you may still go to court and absorb those costs, even though we know that even if you do go to court, your litigation posture is usually significantly more conciliatory because what you've learned about both sides' fundamental interests in that process of arbitration. The fundamental difference between arbitration and litigation is arbitration permits compromise. It permits you to ensure that, for instance, certain trade secrets are kept secret. It permits you to understand why the other side might be interested in pursuing a lawsuit or what concerns they might have. Lawsuits, of course, are necessarily hostile, right? They are often zero-sum in that either one party wins or loses. So two very basic points. First, why we think this is a free and fair transaction in line with all other kinds of transactions we permit in a free market. And secondly, why this solves for certain kinds of market inefficiencies. First, why we think these transactions, the existence of these clauses, is free and fair. The first thing I want to point out is that there exists fair bargaining power between investors and corporations, even mega corporations. Who are the investors in today's world? Broadly speaking, two categories. First, large, powerful, multi-billion-dollar institutional investors, like Temasek, like a Norwegian oil fund. They clearly have the legal expertise, the institutional knowledge, they are repeat players in the market. They know whether or not this clause is something they ought to take on, and they can make an informed decision about whether to buy that stock. But two, what about retail investors, people like you and me? Well, I'm sorry if any of you thought you were actually buying the stock. But the truth is, your stock is being managed by Vanguard or BlackRock because they were the ones who actually purchased the stock on your behalf. In fact, often these institutional investors who sell to retailers are the biggest investors in many of the largest companies in the world. So it is not me, Ashish, suing Apple. It is BlackRock who has sold that stuff to me, suing Apple on my behalf if I am unhappy. And BlackRock, unlike me, Ashish, has the institutional knowledge to be able to take these companies down. In fact, many people say that in the status quo, these companies have much more power than companies do. So we think there is a fair bargaining power here. But the second thing I want to point out is that suppose the existence of these arbitration clauses, mandatory arbitration clauses, eventually come to signal in the market that a company is dodgy, right? Suppose only the worst companies choose to put these clauses in their initial IPOs. We think this is a classic case where the market solves. Because if the existence of these clauses signals to investors that you are untrustworthy, then what happens is that you will raise a lot less money in an IPO. People will be less willing to buy your stock. So we think that is a trade-off which companies and investors are able to make for themselves. In other words, when we create this option, we allow for more information to be put into the market and for the sophisticated companies and investors to make more informed decisions about what they want to buy or whether they want to hold. Secondly, how does this create market efficiencies? 4 layers here. First, we think it is incredibly helpful for startup and industries, which are often not incredibly well regulated, but incredibly important for general social progress. I'm talking about things like biotech, for instance. Not at this point. So, one of the problems when you're doing an IPO as a startup is that you need to have some certainty about whether or not you're going to have some kind of revenue in the future. One of the biggest uncertainties which happens in startups, especially in healthcare, is that if, for instance, your first couple of trials don't go very well, you might be the victim of a class action lawsuit saying that you deceive investors as to how promising your new medical technology actually was. Because that is a huge gray area. It's very hard to say exactly how successful you thought your technology was going to be. But if a startup can insulate themselves from that initial lawsuit, of course a lawsuit might still happen if arbitration fails, if you can insulate yourself from that initial cost, you're much more likely to be able to raise the capital you need to do the innovation you need to do and actually bring that product to market in the future. So it radically decreases legal uncertainties. Number two, it insulates firms from all kinds of predatory and toxic behavior, especially from strategic and tactical investors. There are many investors who actually benefit from companies failing. And we would rather companies not fail because generally companies provide goods and services to society. So let me give you a couple of examples. One thing which you see happening in the real world right now is that many investors end up buying credit default swaps. What's a CDS? It essentially is a financial instrument which pays you money if the company goes bust. What happens when a large number of sophisticated investors own credit default swaps in a company is that they're incentivized to cause that company to fail. So if that company starts a downward slide, if revenue starts going down, if it starts having to borrow at higher interest rates, you might decide as an investor, well, I either sell this stock at a loss, or I hold on to it at a loss, or I cause those credit default swaps to pay off. So I pay a law firm to bring a class action lawsuit against them, I raise litigation costs, and I actually cause that company to go under when there was no intrinsic market necessity for that company to fail, and those people to go bankrupt, and for employees to be laid off. So we think in certain industries that's a powerful insulator against that kind of activist investor pressure. Third, we think this massively decreases unnecessary and bloated legal costs of companies just across the board. I want to point out that legal costs are what economists call a deadweight loss. They don't, as an ex-lawyer myself, I can tell you that when you pay lawyers money, generally no social value is being created apart from that lawyer getting richer. We think the more industries are able to not spend hundreds of millions of dollars guarding against the possibilities of lawsuits, the more that money can be spent just making better products, or even if you're just using it to, pay off your other retail investors, right? Let's think about it. What happens when sophisticated investors have an incentive to see companies fail, or to take these lawsuits against them? Who gets hurt? Well, it's other investors get hurt as well. Other investors who aren't as sophisticated and don't want the company to fail. The last thing I'm going to say is that this counters perverse incentives in the legal industry to push investors into taking up lawsuits. Lawyers make the most money when you are the most litigious. Lawyers make the most money when you take the most uncompromising stance against a company. Lawyers make the most money when you win that lawsuit and the company goes bust. That is not a socially productive use of the scarce resources which we have, and we will rather counter against the possibility of those perverse incentives by allowing companies the option of insulating themselves against this, at least in the first instance, if they believe that is a risk. For all these reasons, propose.
Thanks, Speaker, for that speech. I invite Leader of Opposition to open the case for opening opposition. Yes.
There's a reason why Ashish tells you to ignore the info slide and to condense the motion down slightly. Because the info slide clearly states that this doesn't just affect companies that are looking to go public. These aren't just small companies that want to get investments. These are existing large public companies. Companies like Facebook, companies like I guess Meta is the same. Companies like Facebook, like X. These are companies that are able to allow to put in the clause within their contracts to prevent investors from suing them. This is important for a few reasons. The first thing to know is that they claim that the problem right now is that this arbitration clause will make these companies look dodgy, which means to say that it's a self-correcting mechanism to prevent people from investing in bad companies. The first thing I want to point out is that if the company is very large and established, companies like Meta, for instance, large tech companies like Tesla, for example, then there is no choice but to invest in these kinds of companies. Or the fact that it's going to affect existing investors there already, meaning to say that existing investors are unable to sue these established companies already. The second thing to note is that the problem is that insofar as, even if what I'm saying is wrong, the issue is that if this is an industry standard, if this becomes an industry standard, meaning to say that one company chooses to take on an arbitration clause within their contracts, and another company decides to do so in the same industry, it becomes an industry standard. The issue then is that all companies now have arbitration standard, which means that the arbitration status thing doesn't really act as a counterbalance against the fact that the company might be dodgy in of itself. I want to note this is something that Ashish concedes as well when he explains that certain industries benefit a lot from not having arbitration clauses within their contracts, which means to say that it's likely the case that there are going to be industries filled with companies that have arbitration clauses within them that prevents investors from suing them. Why then is this necessarily problematic? The first thing I want to set up is that it's important to recognize that arbitration clauses are something that really hurts investors because of the fact that many of these companies do have an asymmetrical amount of power against their own investors. They say that these investors are like rich people like BlackRock and whatnot, but the reality is that not only are there many retail investors that exist, but oftentimes there are many kinds of investors that also invest a lot of money into these kinds of companies and have a power asymmetry against many of these big corporations. No, thank you. Why then is arbitration something that works against many of these investors? The first thing I want to note is that the arbitrators that these companies hire oftentimes have a long-standing relationship with these companies. That is to say that these arbitrators are familiar with these companies. They're often working for the interests of these companies. They're not trying to find a compromise between the company and these individuals precisely because they come from the companies themselves. They're hired by them. Notice that it's in their incentive to work for the best interests of these companies insofar as you want to be brought up again for more arbitration clauses in the future. The end result is this, is that many of these arbitrators oftentimes are biased towards the companies, are likely to seek favorable deals towards these companies over the investor. Why then is this bad for the investor? The first thing I want to point out is that it's bad because you are then able to coerce investors in negative ways. You can provide them with bad information. You don't have to showcase them the full details. You can try to frame things in a way that shows that it's negative for the investors. They ought not to sue, but they ought to accept these kinds of settlements that come out of these arbitrations. No, thank you. But the next thing I want to know is that they claim if you're not happy with the result, you can then go towards court and you can then go and get better deals because it helps you better because you then know more about the company. The first thing I want to point out is that if these arbitrators coerce you and try to really convince you to accept those kinds of settlements, that already decreases your ability for you to be able to negotiate with these companies, especially when the option of suing is no longer available. When the option and the threat of suing is not available, it means that your leverage in this arbitration similarly decreases significantly as well. When you go for discussions before the court to talk about settlements, for instance, that becomes a factor because you do not have the ability to then threaten to sue these investors in the first place because you can go through things like arbitration. But the most important problem with these arbitration clauses is that it's not that they don't allow people to sue, but it's the fact that they are meant to separate and divide investors to prevent them from collectivizing in order to pass a lawsuit against these companies. Before I continue, sure.
You clearly think that class action lawsuits solve asymmetries of power. How do class arbitrations function any differently from that?
I think the biggest difference, again, I'll get to that later, but the first thing you need to recognize is that in the class action lawsuit is that you are then able to collectivize resources between different investors in order to go against the company through the court of law. Meaning to say that you are then able to bring in things like lawyers, for instance, resources and information that's required in order to go up against these investors, against the company. The most important thing to recognize is this, and this answers Ashi's POI, is that oftentimes it is the large investors like BlackRock, like your rich people, like the very rich individuals, they have the capacity to sue and the capacity to seek arbitration in the first place. Meaning to say that your smaller investors do not have that ability because there are often a lot of barriers to entry. There are a lot of barriers to suing this company. There are a lot of barriers to seeking arbitration in the first place. So when these big companies are then able to go for these kinds of class action lawsuits, they are then able to take in these kind of smaller investors that otherwise wouldn't have the ability to go and seek out these kinds of lawsuits in the first place. No, thank you. The point of this then is that you are then able to negotiate for you are able to account for individuals and investors that otherwise wouldn't have the ability to go up against these companies, that the investors that otherwise have been hurt in other ways. They say that you can have class action arbitration. The first thing to recognize is that if within arbitration, because you're trying to compromise between a singular investor and the company, it's not in your incentive as an investor to acquire other kinds of investors to go for your arbitration because it extends the process significantly longer and makes it more complicated insofar as you're compromise for the interests of other individuals. But the comparative is that in the class action lawsuit, it's much more easier to do that insofar as it's within a third party judicial law. But the next thing I want to note is that within a legal court system, at the very least you have a third party judge that is able to determine the results of the lawsuit in comparison to the arbitrator that's more biased towards these companies and likely to favor these companies in the first place. The end result of this is this. Number one is that there's a lack of accountability for these kinds of companies insofar as it allows companies to have more leverage within individual deals. At the very least, under our side, even if it were the case that they don't go towards the courts and they go through some kind of discussion first before they go to the courts, at the very least, investors then have the ability to negotiate better in comparison to their side. But the second thing I want to note is that insofar as arbitration clauses exist, it also makes it harder for investors to want to invest in many different companies because of the fact that they now can't seek restitution at the point in which they're unable to seek those kinds of legal recourse at the point where they've been hurt or lied to by the companies. But the last thing I want to note is that it's important for public companies to be able to to be able to get sued because of the fact that oftentimes these companies have asymmetrical amount of power, not only within the investors but also in society. For these reasons, oppose.
Speaker for his speech, and by the DPM to continue the case for opening government. Okay, here.
You all good? Alright. Mr. Speaker, in the spring of 2020, when COVID was really at its peak, I, degenerate gambler, bought about $10,000 worth of Robinhood stock. And 3 years later, Robinhood entered litigation. There was some class action lawsuit brought against it for something that its CEO, Vlad Tenev, had done. 2 years later, in 2025, the class action lawsuit, in the best case possible, settled. I received money from Robinhood. Do you know how much I received for my $10,000? 54 cents. Not even enough to put cream on top of my whipped frappuccino. Even in opening opposition's best case model of class action lawsuits, it's not even like the mum and pop folks like myself and Ashish are going to see that much benefit. Now you might think, but Chin, if the benefits are so small on you as an individual, shouldn't the benefits be quite small at the general level of this debate? No, because 54 cents times 20 million people is very important for Robinhood. Its ability to innovate, its ability to raise capital, its ability to survive. Let's talk about the case. I've got a couple of questions, very bad structure. First question, in response to opening opposition's point about this debate not being about IPOs and other contracts, I want their second speaker to tell me what are these other contracts. I really want to know. Because you can't grandfather in an arbitration clause to people who have already bought your stock in an IPO. That is very no bueno. That is very illegal in every jurisdiction that is not China or North Korea. There are actually, I'm going to give a serious answer. There are two possibilities. You either put in this clause when you raise money in an IPO. For example, let's say I am Palantir and I'm coming from the private to the public markets and I want to raise money for future expansion. Or two, I raise money in a secondary offering in equity or debt. For example, let's say I'm Facebook, and because of the AI craze, I want to raise money to build data centers to power AI research. Possibly this debate is also about two. But even if it is about the second case, every single harm that Ashish tells you about still exists. There are still incentives for lawyers who are advising you on your ECM or DCM deals to be litigious. There are still incentives for really awful, sophisticated hedge funds to sue you to drag out a certain process for their own pecuniary interests. Let me give you an example on top of the CDS example I gave you. There's actually a really troubling trend in US capital markets these days about what we call debt politics. What debt politics are basically that when a majority of debt investors manage to gang up together, they can go to a company and say, make us senior in your capital waterfall. That is to say, if you go bankrupt, pay me first. Don't pay the 40% of other debt investors if you go bankrupt. And how do they get companies to agree? Sometimes companies just decide to agree because it's often cheaper to declare bankruptcy, pay off your 60% and not pay the remaining 40% of debt investors, right? But sometimes when companies don't want to do it, they threaten to sue. They will be like, oh, I could actually take you to court because of these, inconsistencies I found in your financial statements. They really drag out the legal process, make it really difficult for that company to operate, really forcing it to engage in protracted litigious behavior to the detriment of investors and to the detriment of consumers. So, go ahead.
If these kinds of bogus kind of lawsuits are being made, surely judges often throw out these kinds of lawsuits, right?
Yeah, no, but in these cases, as I explained to you, these companies are also a bit distressed, right? They have done something a bit dodgy. It's kind of in the grey area, right? And so my point is that, now, I agree with you. I know what you're going to say. You're going to say, but Chin, think about mom and pop investors, the evil tentacle of the capitalist overlord against Ashish's grandmother. We don't live in that market structure anymore. How do retail investors even get ECM offerings? How do your parents get IPO allocations? They get them through large institutions like BlackRock and Vanguard that have done the due diligence, that have legal teams that are arguably larger and more financed than these companies in order to even offer them to retail. I would argue that folks like Vanguard and BlackRock are the most regulated financial institutions in the world. And actually the market structure has shifted towards a vast majority of these companies issuing ECM deals being startups that are relatively under-resourced when you compare them to the centralization of financial institutions on the retail side. So that's my answer to your POI. Next thing I'm going to talk about. this idea of optionality, I think it's really important. Remember Ashish said in his point that you're not compelled to put a mandatory arbitration clause in it. That's really important. In order to illustrate why it's important, I'm going to share a personal story again. I found it really difficult to get good dates on dating apps like Hinge and Tinder. Why? Because generally speaking, the most desirable partners get matched up early on. So everybody who remains on dating apps is actually signaling that they are less desirable. I.e., the technical economic term for this is a lemon. Just like being on a dating app signals that you might be a bad date, if opening opposition is right, that the worst companies will impose mandatory arbitration clauses, that clause will signal that you might be a crappy company. It's like when your Bumble says, on the app for 5 years. And how does the market solve? The market solves that by increasing the cost of capital, by increasing the punitiveness of the valuation that you're able to raise money at. So instead of raising, for example, at a 10x or 11x PE multiple, you're raising at something like a 3x or 4x multiple. The market solves for that. You are being compensated for the additional risk you are taking. That was Ashish's argument, never rebutted by opening opposition. The last thing I want to point out here is that arbitration is not done by the company. It's also not done by the company's cronies. There are independent arbitrators who very often tend to be former judges, and both sides are represented by specialist arbitration lawyers. The main difference is that in arbitration, you have to take the other party's interest into account as opposed to a lawsuit, which is inherently adversarial. What does that mean? It means, for example, that you are unable to compel a company to provide information that could be classified as trade secret. So the relative bar is a bit lower when it comes when a company says, I want to protect myself. Can a company do things that provide false information? No, that's highly illegal and it will destroy your company if you do. Many of the rules that apply in arbitration are also similarly applied in lawsuit. The key difference is that the cost of litigation is much lower because arbitrations tend to be concluded in something like 3 to 9 months as opposed to an order of years and sometimes even decades. And yes, maybe in a world like the 1960s, right, where people placed orders through their broker and might have to gang up with like 10 other dentists to do the arbitration, you are probably disincentivized and you are probably at a disadvantage. In a world where your arbitration lawyer works for you because you are BlackRock, I would argue that that's a pretty fair process. You get a pretty expedient outcome. I think a lot of the benefits flow through on our side. I'm incredibly proud to propose.
Let's speak about speech. Invite the dear Lord to review the case for opening opposition. Here.
I want you to savor the impressiveness of the previous two speeches because I'm going to cut through it and explain to you where the case falls. The specific way in which I want to do so is to go through the actual arguments that they gave you and showcase how it actually lacks in rigor and point to you where the actual meat of the persuasion really lies. The actual meat of the persuasion lies in the framing that this is a balance, this is a fair engagement between institutional investors and big businesses. I'm going to take that down. Once I take that down, the case falls apart. For you to really see that that is actually where the meat of the debate is, let's go through the arguments that they've told us. So the first big argument is that, well, this is going to help because otherwise firms get bogged down into trivial lawsuits. But this assumes that it's a very low threshold for courts to accept lawsuits in the first place. This is probably not true. It's something that's trivial, like making up lies when we actually have not done so, these lawsuits get thrown out. The second argument that they had is that potentially it makes it so that investors act against the interest of the company, specifically in the case of CDS. But similar to, for example, how we ban insider trading, if it's the case that there's a moral hazard in having investors act against the interest of the company, we can ban those things as opposed to resort to this mechanism. The third argument is that I don't know, like lawyers don't deserve money. Like this is an argument. I don't think so. The last argument is that the legal sector compels you to then have lawsuits. This is an extension of the previous argument. My counter response here is just that for these businesses, they also have in-house counsel to advise them. So if it's the case that a law firm says you should sue, and then your in-house law counsel says you should not, then probably you will be able to make a good decision. one of their key arguments here is, well, at this point, maybe this is a choice. You surely should allow two people to come together to make that choice, and if it's the case that is fair, then that will materialize. Guys, were they persuasive? Were they able to at least tell you in the moment that it feels as though these policies are pro-business? Were they able to weaponize your hate against the legal industry? To at some point just think to yourself that, hey, this is a clause that we can have, that we can handle. If at one point of time that you were persuaded by that, then your average investor might be persuaded by that too. Firms do have the capacity to hire these two guys to go into a room and tell you that this clause is okay and you will sign off on it. And if that's the case, then you will then concede that this is potentially a moral hazard. If it is so, we need to remove that. Like, clever argument, but assuming that that's true, people would never include that clause in the very first place. Clearly, if it's the case that people can be persuaded, terrible things can happen, which is why the SEC, for the longest period of time, has not allowed that to happen. The next part of this speech then is, why is it the case that the framing at the start doesn't work? So I want to really just point out that, in terms of impacts, there's really nothing left. All that's left here is the assumption that firms and businesses operate on par, that they have equal amount of resources to then fight things out. What I want to talk about here is that the frame of going to IPO isn't one between BlackRock and big businesses. And the reason for that is because as a small firm, when you first fundraise, you don't fundraise with BlackRock. You fundraise with people like you or I, or at least like people who are a bit richer. Presumably they can afford retirement, for example, and therefore have a few $100,000 if you put in that amount of money. But when you scale up and then you start interacting with BlackRock, it's a point in which your interests also change. You no longer want to defend the investors with a couple $100,000 in the first place. Your angel investors are first started investing in your firm, but you want to take care of the big institutional investors. And what you do then is, for example, you dilute their shares. So you issue up more shares so that they have fewer degrees of, less control of the company. Or for example, you issue up different classes of shares. So for example, if you try to buy Google right now, they're class A, B, C, D, super confusing as an average retail investor, as an angel investor. But these shares, for example, carry special voting rights that you might not be aware of. And what that means then is that there is a clear case as to when as a firm goes IPO and tries to rapidly raise more money, they do have an incentive to screw over the previous investors because those guys hold a piece of the pie, when you break that piece of the pie to either reclaim it to the company or give it to the institutional investor. That is when these people get screwed over. Clearly then, they should have the ability to potentially sue. Is it important then that this is something that they have access to? Yes. So in the same way in which you are able to, convince people in the arbitration rooms, and convince them, I think in the absence of that discourse, that's potentially a good thing. At this point, what they have here is just, well, arbitration is just a conversation. Surely you should be able to have a conversation. My argument here is just, if it's the case that arbitration is mutually beneficial, people can also have arbitrations on outside the house. The clause is mandatory arbitration. It's when people do not want arbitration, they're forced to be put into that room and given information that they otherwise do not want to receive because they know that they will be coerced, that they will be influenced by that information, and they'd rather not have it. What would they rather do? They'd rather connect with other investors and hope that they are also in those investment environments and they can collectivize accordingly. That is what we allow these people to potentially have access to. Before I go on, sure.
Does changing the share price and voting power of shares not also affect whether a class action lawsuit can accrue?
If it's the case that you are making it a mandatory arbitration, you pull these people into a room, you give them false information, you coerce them, you influence some people to drop those lawsuits, then the capacity for you to weaponize a class or action lawsuit is drastically lessened. On outside the house, if it's the case that they don't want that process, then they should be able to not have that process. If it's the case that they do want arbitration, they can still engage in arbitration. I want to just point out now, at this point, that they are just better, the court of law is a better mechanism to protect individuals who with less capacity for legal fees, with less capacity for information in a couple of ways. Number one, the process is longer, which means that there's a stronger process of investigation. So if it's the case that you can collect information, if it takes time for you to reach out to different members to build your case and grow your class action lawsuit, you're able to do so. Number two, there's no in arbitration there's no capacity for appeal, right? So at the court of law, if it's the case that things go through and things go wrong, or you feel as though the process is not fair, or the same. I want to note that I think the firms do have the capacity to engineer how arbitration ought to look like. So for example, they might engineer it as per, you cannot do class arbitration because obviously why would you want to do that? You want to do individual arbitration. You want to force the people to come into the room with you alone and then talk them out of getting into a lawsuit. At this point then, I think the last argument that they have is that lawyers just eats up a lot of money. So poor Chin, because he got 57 cents for his $1 billion investment. At this point I want to note, look, lawyers cost money to both the firms and the investors. If that is true, what that means is that the firms also have an interest to cut the lawsuit short by minimizing that process or engaging in arbitration. why are they not doing so? Why do they want to drag you through and do legal things in the first place? It is because of the fact that they have something to hide. It is because of the fact that they have the power to control you, to guide things through, to make it so that you're influenced in the court of arbitration. That's why they're doing it. So, like when they say, well, these companies will be punished eventually, like when they say that eventually, at the end of the day, you just have so little money left, even if it's the case that you don't get a lot of money at the end of the day, the preservation of that process for justice, the deterrence that you put on companies so that they can no longer access that process, are all worthwhile things that we preserve on our side of the house.
Thanks for your first speech. I invite the member of government to open the case for closing government. Here.
Two extensions from closing government. The first is a vertical in terms of why IPOs happen far more and why this actually causes innovation that outweighs other impacts in this debate, so clearly winning on that clash there. And the second is a deadlock breaker in terms of why individual arbitration is sufficient, or in other words, why there's a fair balance that already exists. The idea that OG introduced, the world make sure is more clear as to why this is already balanced. First extension as to why IPOs happen. So an IPO is an initial public offering where a company essentially goes from the private market to the public market, selling its shares in order to raise a crap ton of capital and money so they can start their actual business. The alternative is that these companies would instead say privately owned by private investors like PE, for example, or like, I don't know, hedge funds. And so that instead we think is a far worse alternative. Why is it that class action lawsuits are uniquely restrictive in not allowing IPOs to happen? This is because the cost of a class action lawsuit in terms of the legal fees is far higher than individual arbitration. Because class action lawsuits often includes far more witnesses. So you have to do far more interviews, and you have to deal with far more voices. That process takes a very long time. So your lawsuits often take far longer. But when you also have a class action lawsuit, there's an increase in public scrutiny as well as the public protective laws that need to exist. Things like anonymity, or the fact that all voices are heard, there's like accountability and respect for like all of these individuals. That increases the procedural overhead, which makes these lawsuits far more expensive and thus causing an actual significant trade-off with things like innovation. But secondly, in the area of, for example, medicine or biotech, you often need to find a lot of patients and test individuals. The problem now is you have to be far more afraid as to whether these people could be involved in a class action lawsuit, which means that it is far more difficult to find people who are willing to be convinced to work on this project, but also like you need to check if they're willing to be accepting of risks and whatnot, do more waivers, but it's also hard to find people who are accepting of these risks. That is incredibly restrictive on your ability to actually do research and growth. So on our side of the house, there's a clear margin as to why more companies can now do IPOs because they're protected under the safety of these arbitration clauses, which we're defending on the government side. Why are IPOs then probably good and beneficial? We have a massive capital flow into companies, which is why companies want to go public to begin with. And we think in the long run, this leads to massive amounts of innovation. This is because innovation has incredibly high iteration cycles. So for example, developing new technology is sometimes speculative or uncertain and takes a long time. Or within the specific case of medicine, it is uncertain if your outcome works and you have to wait 10 or 20 years to see the after effects of your medication to see if it's actually worked out. So those are incredibly long cycles. This proves that you need initial capital, one, to start this investment, to pay patients, to ensure they can actually be hired, and you have to pay people to keep showing up and telling you if the medicine is working or not, and to continue taking it. But it also gives you a capital base, which you can then use to get more loans compared to what you have right now. And public equity allows you to do that far better, to actually capture capital to spend in the future instead. Why? In terms of incentives, are public incentives better than incentives of PE? So this is essentially why they're going to be run well and why these companies have good interest. I think that they're far more long-termist. So often public investors look like big institutions like pension plans, which hold billions of dollars of people's everyday lives. And the goal of a pension plan is to make sure that when you retire, that money is still worth a lot. So they do long-termist investment to ensure that the company is operated in good ways, in sustainable ways, not just to get short-term growth or scam investors, but rather to actually create productivity that ensures they have sustainable income in the future. And I think also it can be things like reputation. If it's a hedge fund, for example, who has many investors, they need to have a reputation to future customers that they will make profit for them in the future as well by showing that they have long-term viability as well. But also things like families who are incredibly rich and famous, or like, they want to protect their legacies and make sure that they own companies which are successful in the future as well, not ones that have failed because that looks bad and tarnishes their reputation. In the comparative, we think PE in private equity, which does investments, is far worse. Private equity is notoriously known for doing leveraged buyouts, which means that they often will buy these companies using the debt of the company itself and using assets as collateral. So what this does is it increases the risk of collapse on debt, leading to bankruptcy, or the hollowing out of firms at the point at which you sell the firm in order to make back the money, just to pay back the debt you used to buy the company in the first place. That's incredibly predatory and kills innovation because these companies go under as a whole. But secondly, I think that even if there are windows that lock in PE investment, these often aren't followed. And this is because the key incentive of private equity is to have liquidity as opposed to stability. This is because PE is often highly diversified, so they invest in many things. If investment A is making far more money than investment B, I'm going to be very quickly pull money out of investment B to put it into A instead because it's more profitable, which means my investment is very uncertain and short-termist when it stays private. And this often looks like other things like cost cutting or raising consumer costs in the short term at the trade-off of long-term reputational harms, but they don't care about the long term because they're not in it for the long-term game. That's harmful for consumers, that's harmful to innovation, and it's harmful to the reputation of the company as a whole. Why should you weigh this on our side then? We get far more innovation because of long-termist investment that we unlock when companies are allowed to actually IPO and are able to take on that risk. One, I think innovation affects a broad range of fields. So for example, no thanks, there's a cross-industry boost if you work on AI that can have multiple effects in different industries. So that's massively beneficial. And just empirically, every dollar spent in R&D returns like $5 in terms of real GDP or productivity. Objectively, when like economists measure this, I think that's highly beneficial. Two, innovation is very likely to succeed because often innovation can self-correct. Off might say you don't know what's going to work or not, but there are things like tractability measures to see how many citations your work is getting and how much interest there actually is, as well as failure mitigation, i.e. if something isn't working, you can quickly pull it back through the things like altmetrics to see if the internet, if there's like people, are they Google searching my product, is it likely to actually succeed or not? So I think it is likely to succeed. And I think research has a massive impact on the vulnerable because research often looks for where the smallest amount of resources can cause the highest return on investment. So one new medication is likely to exist in an area where it never did before and have a huge impact, far greater than anything that like happens when a class action lawsuit protects someone from like a trial being misrun or something. We save far more people. And finally, there's a multiplier effect. When we have far more firms inside of the economy, this is far more companies who can collaborate, who can learn from each other, and build off of each other's research to then create far better investment and innovation in the future. This is the only concrete impact we've heard at the round so far. I think it outweighs anything else. Yeah.
If your company is so dodgy that the main reason you don't IPO is an impending class action lawsuit, maybe you shouldn't get to IPO and be allowed to sell your rubbish to the public or premium or pension plans.
Okay, so the primary issue is that we don't think a lot of these companies are actually like dodgy, and the issue is that there's already sufficient accountability, which I think causes a lot of deterrence for these companies to actually enter this. So you can be not dodgy, but be scared that someone will think you're dodgy. There's a significant margin there. So this brings me to the second extension. So why is individual arbitration sufficient? One, I think that settlement leverage is also good for people who are suing, because it inflicts reputational damage on the company, so deterrence exists. It sets precedent for judgments for future times in which similar cases will also be ruled in the same way, which leads to long-term harm and fear of those long-term harms. But it can also do things like reduce the price of your shares, which I think is something that people are incredibly scared of. So deterrence is already sufficient to our side. Two, if you look at the incentive of judges often want to strike corporations down. They put higher standards on big companies because they're viewed as well-resourced, and so the scrutiny and expectation on them to follow laws correctly actually is higher. And this is especially true because the public trust, as Oath exemplifies, is incredibly low in corporations already. So there's already a high level of accountability that exists in the status quo, which means then I think that the judges are far more likely to approve class action lawsuits to deter future misconduct. But on the comparative, we prove that you have better behavior and innovation on government. We don't need class action lawsuits. We're incredibly proud to propose.
Thanks for the third speech. I would now like to invite the member of opposition to open the case and close the opposition. Here we go.
extension is just to merely flesh out the comparative as to why class action lawsuits are just fundamentally better because of the fact that it is far more visible, far more transparent, which is why it's important to holding these companies more accountable. This directly engages with the, I guess, 1 minute kind of argument on why accountability can still exist within Oddventure coming from CO, but it's also able to flip a lot of the framing coming from OG in itself, because OG explains that it is bad for a lot of these kinds of smaller investors because the legal costs can be used for other things, and why this is something that's bad. But we will explain why is it that mandatory arbitration often legitimizes bad corporate behaviors because it often happens behind closed doors, and we'll explain why the comparative for lawsuits is just far more better. First, how does mandatory arbitration legitimize bad corporation behaviors? Note that because arbitration often takes behind closed doors and it takes in very controlled environments. What does this mean? We think this means that we're operating under OG's frame here. OG says that often companies get to choose what the arbitrations are and often gets to choose arbitration that are often in their own interest. We think this is particularly bad because it means a few things. Number one is that the calculus of these companies when it comes to engaging in these kind of disputes with your investors, especially within arbitration, is that often they want to be within their own interest. This means that factors such as how does public optics perceive this, whether or not this affects external investor confidence because of the way they engage in this arbitration, are often factors that are being excluded within the mindset of engaging with this arbitration. These factors are important because these are often mitigating factors that exist to hold companies in check to ensure that either number one, they are able to settle these kinds of lawsuits in a more fair way possible, or second, they are able to either change their behavior after that lawsuit so they're able to meet the industry norm of standards as to what are considered good corporate behavior. The reason why is it that in the their comparative of when you allow mandatory arbitration, these kinds of companies, because of the mental calculus of being able to perform this within controlled environments, often than not, they are able to and want to draw out arbitration as long as possible, and they have the capacity to do so. Because number one, arbitration cost is just lower, and number two, because they are insulated from a lot of the public optics. Reasons such as, number one, a lot of the dodging behaviors, these are information that are often being aired out as opposed during the discussion of this arbitration, or the comparative of discussing within its court facts are often being out in the open. Secondarily is that your trade secrets cannot be out. So this means that there's just no urgency for these kinds of companies in order for them to solve this arbitration as soon as possible. So they're able to draw as long as possible. It's unclear why is it on their side companies are going to be incentivized to behave in better ways insofar they can often hide within these kinds of insulated environments of arbitration. The comparative of lawsuits is just far more better. I want to just flag out here is that OO doesn't really flesh out the comparative of lawsuits. So within, at the end of OO, you're able to understand perhaps arbitration is bad because there's conflict of interest, because it reduces investors' ability to negotiate, but there's just no positive comparative for you to hedge it against on, right? But before that, sure, close opening.
So if your point is we need courts to threaten companies to settle, isn't it hung on disputing our case that the market structure is such that investors and companies are quite on level footing and you don't need to threaten companies?
But like number one, we are unclear whether or not these are going to be small investors versus big companies. So if it's true that in large instances where it's going to be big investors or versus big companies, we don't think a large chunk of debate happens there, because it means that a lot of the asymmetry argument, a lot of arguments such as exploitation don't really exist here. We think it's far more likely in situations where it is going to be about big companies versus small investors. But I think I would argue that our extension doesn't really matter whether or not it's going to be equal footing field or not, because what we argue is that the information and the legal precedents that exist within this kind of class action lawsuits is the one that creates the kind of accountability within this corporation. What does this look like? How does this visibility exist within class action lawsuits? First is that the process of lawsuit itself looks like a lot of media reporting and scrutiny as to what actually exists with this kind of class action lawsuit. What are the kind of market manipulation that these kind of companies have actually done to these kinds of investors? Second is that this information is now going to be publicly known by all of the investors and companies within these kinds of industries as well. Also, thirdly is the idea that a lot of these court documents are public, meaning that a lot of individuals have access towards what actually happens and goes on within these kinds of class action lawsuits, these kind of discussions. Bottom line here, it means that there is an active incentive for companies to now want to settle these kinds of court suits. It's either number one, want to have settlements really, really fast, and often this means because they perceive it as more of a cost if they were to continue to allow these class action lawsuits that exist, because they view it as threatening their own public confidence within the companies in itself, because you allow this kind of information with these kind of class action lawsuits to be continued to be aired out. The comparative is that they are much more willing now to give out settlements that are much more favorable and much more of a one-time of a settlement, because they perceive this as much more favorable publicly and popular. Also, second is the idea of exclusively these kinds of class action lawsuits also provide some form of legal precedents that set industry standards as to what are the kinds of behaviors that are being tolerated and what are the kinds that are not. This is important because within arbitration, the outcome of arbitration is often one that is either number one, only known by these two individuals or these two parties, or just that number two, the outcome of arbitration does not have any form of legal standing, therefore it is not particularly binding towards other actors within the same industries in itself. Or also thirdly, sometimes within arbitration clauses in itself, you are forced to sign some form of NDA document to ensure that the information in this arbitration is not known towards the public in itself. What does this mean in the comparative? The comparative legal precedents, when everyone now knows what is the kind of information that's being aired out, it acts as a signaling effect for companies to not want to act as bad because of the idea they don't want to end up unpopular, they don't want to reduce a lot of trust if they were to end up within the same kind of lawsuit that exists in the status quo. But it's about why in the long run this is something that is good, right? Because if in the first place we allow some form of legal precedent to happen, it means that in the long run we're able to now reduce the kinds of cases that exist, or we're able to speed up the kind of court disputes that exist as well, because you're able to draw parallels to the reference frame of the kind of legal precedents that have been set. Why is it that at the end of this speech, accountability and the visibility of this kind of information is the most important metric that you ought to weigh over fairness such as that exists within OO, or such as allocation of cost for other things like innovation and camera from CO and OpBench in itself. We think that just because, number one, the idea of accountability and incentivizing good corporate behavior is the most direct and proximate way to fulfilling the purpose of the SEC in itself, to regulating these kinds of industry standards. Also secondarily is the idea of why the democratization of these kinds of information within this lawsuit in itself to investors and companies just allow much more better and more informed decision making for a lot of these investors, meaning that if it is true that these investors have lack of capacity in terms of monetary resources, at the very least, we allow them some form of additional information so they're able to navigate better decision making using this kind of information if they lack monetary resources. Also thirdly, is that metric like fairness is hinged on very circumstantial factors. The value of the information exists irregardless whether these things are small or big.
Thank you for that speech. I invite the government whip to close the government case.
The OpBench loses because they do not tell me what class action lawsuits do beyond things that are trivial. There's an amorphous gesturing towards justice and transparency, but the wells in Hinkley are still poisoned. The fentanyl crisis still happened. CG tells you that the remaining voices left are now obscured behind the veil of private equity, preventing any sort of recourse. The first thing I want to do is to guard against opening government and why we are unique. I think what happens if we don't IPO is missing an opening government. The industry does not disappear. There are a select few who have the incentive to still accrue and set up shop, but this goes to the private equity market, and IPOs are not the only ways to enter the market. The problem here is that the ways in which, like Alex tells you that there's an incentive to enter the private equity market for the reasons he tells you, which is that there's capital still available there. You still have the ability for you to be able to gain some level of ability to succeed, but also that presumably there's some ability, like there is more, like if the alternative seems to be too gun shy, for you to be gun shy if you IPO. So some of these companies have the ability to IPO, but don't, and this becomes the tipping point specifically towards you not IPOing and diverting towards private equity. So you have the choice specifically between IPO and private equity, but the cost specifically of you not IPOing should be far higher, as Alex posits. This has a number of parts. The first is which we established to you is the way that private equity works, i.e. it has very little capital available. The way that investment works is like Canada's pension funds, but there's a liquidity crisis happening there, i.e. that the ability for you to be able to gain capital to begin with is extremely suspect. The ability for you to be able to withdraw your shares specifically from private equity becomes extremely difficult. It's actually now there's a liquidity crisis there, and they think that investing there is really bad. But the second thing as well is that the way that the investment works is that private equity removes and cuts costs. It cuts costs in important areas. So that means that like managerial issues and poor products usually happen. That means that injury and death in nursing homes spiked, especially when when costs were cut for how much you will pay your nurses. That a good chunk of the healthcare under the private equity industry has ruined the hell out of healthcare industries within America. But and the choice to go there to avoid things like accountability, for example, makes it extremely difficult for people to want to trust hospitals and trust nursing care homes. That's really terrible. The reasons here that we give you are why the counterfactual is quite bad. So if this market doesn't magically disappear, the market still makes it worse, i.e. that the profitable and large companies are still publicly listed, but the problem is the middle and the majority of hospitals and companies who are gun-shy, who don't want to be sued and who don't want a lawsuit, who get away with it and enter the private equity market. The impacts are manifold, which is that there's a health industry at stake here. The impact here is that people die at the point that the nurses are not good. People, don't like many old people die at a point the nurses are not good, specifically within these areas. We think that the comparative here seems to be that you specifically are under the SEC and the initial kinds of policy regulations that you have. So to enter the SEC and to do things like IPO, for example, you agree to a bunch of regulations specifically within these areas. You agree to staff your people properly. You agree to some things that subject you to public scrutiny. That doesn't happen on the other side of the house at a point that private equity accrues. Before I move on to bashing OO, yes.
So you're telling me that this company wants more money to expand, and if they don't IPO, they will take money from private equity firms with a track record of stripping down the company for parts.
No, so it's not the only thing that private equity does. They don't just strip companies for parts. They also do it specifically by biotech, for example, is an industry obviously that is profitable, but they want to avoid the kinds of scrutiny specifically that exists in publicly trading things. The comparative is that when we encourage more biotech companies to move towards IPOing by reducing the barrier to entry, then presumably this also means that the biotech companies become more transparent. So private equity doesn't just strip companies down. It's not just for failing companies. Like niche, like industries, for example, like biotech, also specifically exist in private equity firms. But the second thing as well is that when they do, they become significantly less transparent. That's our comparative. Therefore, the first thing they suggest is that the first problem I have is that there's a missing incentive, because this assumes that class action lawsuits work. But all of Wayne's analysis applies to suits as well. The way in which the law companies do so is to take on more risk. But the answer to the POI is that if you are dodgy, you go to private equity. But the problem is as well that if you are dodgy and don't allow for the initial kinds of regulation specifically from the SEC, the market doesn't correct for itself. But on our side of the house, the market does correct for itself at a point in which that like publicly listing your firm subjects you to a bunch of regulations that you have to follow. The second missing gap is that the choice is meaningful. This is when Tan's accusation of grandstanding from the opening government backfires, because he says that that people ought to have a choice because people really, really want it. I really want a toxic boyfriend, but I really shouldn't, right? And the point being, right, that people can want things, but if the things that they want are not good for them, we shouldn't allow them to have those things, right? So the first thing is that it's extremely unmeaningful because it only looks good, right? The actual real things that are being done often accrue PR specifically for the companies for them to be able to circumvent the actual real problems that exist. So greenwashing, for example, is a very real thing. Obviously speaking, there are things being done, right? But it allows for companies in the long term to be able for them to skirt issues like that, for example. But the second thing is if neither side's arbitration mechanism is the metric arbitration mechanism is subject to both sides arbitration mechanism is subject to this. So this means recompensation ought not to be the metric you use to judge this debate. So OG says that we recompensate through paying them money. OO says we recompensate them through paying money. OG presumably wins by saying that they get a bit more money. But here's the problem, right, which is that both sides of the house specifically agree that a lot of the money is uncertain to begin with. What is certain is the benefits specifically from you listing under an IPO, i.e. that things like, for example, increased scrutiny and increased innovation are certain. The way uncertainty is quite clear, but the second is priority. Do you want to have legal precedents? Says closing. Yes. So to get legal precedents, you need to be under the SEC and the IPO first before you can get prosecuted. Yeah. So if you don't have the information and you're not publicly listed, how are we going to even sue or arbitrate to begin with? That's the problem. Because for you to try and sue and arbitrate a private equity firm, there's many more hoops you have to jump through, and you're not subject to the same scrutiny either. Therefore, we think that to come prior towards closing opposition, we think you just need to be publicly listed first. Lastly, on the counterfactual, they say you're not beholden to people, but again, you're not beholden to people on either side of the house. So the odd teams then don't have a margin to stand on. Lastly, on closing opposition, they say dodgy behaviors are now out in the open. Yes, we didn't know that Pfizer doing shady things. We don't know that a lot of these people doing terrible stuff. Bro, if you open a newspaper and you look at it and you're like, oh my days, the big companies are out together, duh, right? I don't think like them being like, yes, the big companies are out to get us now becomes the tipping point. I'm just not sure that that is the tipping point. But what I do think is the tipping point specifically is the scale in which that this impacts individuals that we have explained to you, which are more certain and a lot more vulnerable. Closing up.
Let's take a back speech and invite the opposition whip to close the debate. Here.
Okay. I want to very quickly take CG out of the debate. Beyond the impacts that are downstream of what OG already claims, they bring to you an analysis of why necessarily IPOs are important, and if you don't get IPOs, you'll go towards private equity. That's worse because necessarily you get more funding, like you get less transparent actors and more bad policies. I want to explain a couple of things. First, they claim that, oh, it isn't just they strip companies, and presumably that's why people go to IPOs, but they also hide a lot of things. As far as I check, private equities are still subject to SEC regulation. So which means SECs can still investigate you, can still audit your books, and still check all the shady shit that they claim private equity is probably going to hide. Which means that the scale of information that is likely going to be hidden by private equity versus an IPO is likely very marginal and also probably very illegal. So private equity does not hide any more than private equity normally does, and the SEC does not investigate any less than the SEC already does. Which means the bulk majority of their claim as to the nature of transparency as towards IPOs, towards private equities now becoming the predominant option, just simply doesn't manifest in the context of the realm. But second, this also I want to attack the core claim here, which is that individual companies now at a point at which IPOs become extremely bad because you have to always go towards court, you will now predominantly opt towards like vulture funds and private equities. Just because IPOs get more risky does not automatically mean every single company now opts towards private equity. Why? Because there are very clear reasons why private equity is not a great actor for the very reasons CG analyzes. Which means what this does is just changes the risk calculation factor that what private companies do. Which means if a private company is so scared of a lawsuit and they rather opt towards shady companies, number one, this probably wasn't a very good company to begin with. Secondly, if they want to be in bed with shady private equity, then there's a whole different struggle. But what normal companies will do is factor in this alleged risk. So what does this probably look like? This probably looks like increasing your legal fee budget in your company when you go public because you know that this is an actual concern. So this doesn't look like a vast shift towards broad levels of private equity. It probably just means IPOs happen, maybe slightly less, but most of the companies that already were going to opt into IPOs are likely to happen. So all the downstream impacts therefore about like less investment, less transparency, just doesn't materialize insofar as they don't substantially prove why necessarily this was a tipping point for a large proportion of companies to simply go towards worse actors in terms of funding. Therefore CG's out. Fine. No. Let's talk about a couple of things. And this is how I'm going to weigh this. It's going to be very weird, but keep with me. So, there are a vast majority of scenarios when this occurs. And this is the biggest problem with the top half clash. You don't know whether this is a big investor, small investor, big company, small company, big like BlackRock or like Vanguard or just individual things, right? There are a large quantity can happen. What all does sufficiently prove is that these are likely going to be industry standards. So what OG claims as to like, oh, individuals can pick and choose which one is going to happen is sufficiently proven and like an accepted premise in the round that majority of these companies will opt in towards mandatory individual arbitration. I want to make sure that there's a clarification of what mandatory individual arbitration is. Because OG claims that these are arbitrations that individuals can also do collectively and then can always go towards courts. Number one, mandatory individual arbitrations are oftentimes contractually bound, which means if you break your arbitration and you simply go to court and sue, that's a breach of your contract, which also opens a whole other can of worms. So individuals cannot suka whenever they like breach their contract. They have to necessarily go through processes of arbitration, which are long and drawn out, which what NC claims. But secondly, more importantly, these are individual arbitrations. So you don't get class action arbitrations or there's our class-based arbitrations. You have to do individual stakeholders as a whole. So let's engage all scenarios more charitably than what OO does. Let's talk about three different scenarios. Number one, let's assume that what Ashish says is true, that all investors are managed by BlackRock or like a large proportion of individual retail investors are managed by BlackRock. So let's talk about BlackRock versus Robinhood. What does Gov claim here? Gov claims two things. Number one, mom and pop retail investors do not get necessary benefits because Chinwe only got 54 cents upon his investment. Why is this something that isn't happening? Because this doesn't change on either paradigm. They don't explain why arbitration leads to you getting significantly more money. So just because you engage in arbitration independently, if BlackRock engages in Robinhood arbitration, I don't understand why Chinwe gets more than 54 cents. Maybe he gets 60 cents. But I don't know why this significantly changes on a scale. Like this isn't a proof that comes from opening up government. But secondly, they claim that this prevents Robinhood from innovating, and I claim this is like also the CG claim as a whole. First, For a vast majority of the firms that they do mention, like tech firms, like fintech firms, I'm unclear as why I care significantly about them innovating as a whole. Presumably, maybe I care about it biotech. But the very thing that Eunsi explains to you is that oftentimes budgets are limited. If you run out of your legal budget to prosecute a court, and you probably settle. So this isn't something that occurs. So the consequence of innovation just simply doesn't happen, which mitigates a vast majority of the CG cut in low IP. The implication is this debate, if it happens with BlackRock versus Robinhood style companies, is that the change is very marginal whether you engage in individual arbitration or not. So this is probably not where the significant harm of the debate actually occurs. Secondly, let's talk about the biggest OG car, which is that it's a small startup versus like Vanguard. Now before I go on, yeah, Ashish.
You claim that threats of litigation are public and impactful. We agree. Doesn't this also imply that even unfounded litigation, when it's threatened, massively destroys share values?
Okay, I'll literally get to that here, right? So what if it's a small startup versus Vanguard and like public litigation actively damages their share values? I think a couple of things. First, targeted legal attacks triggers things like CDOs and other behaviors in order to trigger and CG claims that don't need. The problem is, even if we agree that frivolous and like bad lawsuits still have some level of stock effect, the change is incredibly marginal. I am unclear as to why a stock plummets 200% upon which this happens. Secondly, oftentimes frivolous lawsuits get thrown out fairly quickly, like what O mentions. The key impact that doesn't happen is, upon a frivolous lawsuit gets thrown out, your stock price bounces back. So I'm unclear why the stock price stays at below 200% and just remains there, upon which you are getting these kinds of dodgy claims being thrown out. The claim here on OG is that, oh, they must have done something wrong. There's no substantial proof to that, like we're just throwing assumptions here around. So it's more likely to happen in which you don't get the harms of protracted lawsuits. Because if this was as frivolous as what OG claimed to be, about like investors just wanting to tank prices because they want TDOs, these are likely going to be thrown out. Secondly, they claim there's an asymmetry of power in startup. If necessary, this is good. But those same asymmetries exist under arbitration. There's no ability to stop Vanguard from hiring very good arbitrators versus your small startup who are unable to hire arbitrators of similar skill, which means necessarily the harm here is also greatly symmetric. Where therefore does this debate take place the most significant? This takes place in Pfizer versus the small investor. Now they claim that it's going to be BlackRock and large companies. While this may be true, a lot of retail investors also exist in forms like retail hedge funds, smaller pension managers, which may not be significantly big or significantly small, but are small enough to still have significant money to invest, but not have the same money in order to invest in stuff like legal fees or stuff like good arbitrators. Why is this important? The reason why the larger change occurs here is because small pension funds or small and alongside small retail investors can band together, and that's the exclusive thing that CEO proves to you is why we get, because investors are prevented from banding together under the side of open government. So this solves costs. When arbitration is done on their side individually, they're unable to hire good arbitrators, they're unable to hire significant pushbacks. We're able to at least collectivize and get good court systems. Why are good court systems bad? Why aren't you exclusively winning? The unique mechanism we provide to you is public visibility, which is the tipping point for equalizing recourse. One, this changes companies when necessary. They have to prevent their share price from dipping faster. They're likely to settle, which means less protracted fights. But number two, this allows for precedent. It means every subsequent case after the first becomes a lot faster and a lot more efficient. This is why CEO wins.
Thank you all for the debate. Please cross the floor, shake hands, and head back to the auditorium. Thank you. Yes, Doctor.
Thank you.